I think they should. Oh. I think the microphones are on, right? So, good afternoon, everybody. Thank you very much for joining us on the Innovative Equity Pathways panel, or simply speaking, the Equity panel. As you know, the EBRD, as well as other IFIs, we have the biggest footprint in debt instruments. But we thought, at least I thought, it would be very opportune to talk about equity and how equity supports our development mandate. You know, debt is project-based, right? We finance projects. Equity, we finance management. It's a completely different mindset, and this is what makes our hearts race. There's a total different level of conviction that we need to have in order to invest equity. If you think about the EBRD as a rock band, equity is the guitar solo. So you're actually always in the spotlight. People will remember that if it goes wrong or right. So the spotlight is there, the attention is there, which is why we need conviction and why our heart rate goes up. But we are minority investors only, which is why we rely on the best partners we can find. And the best partners we can find are sitting here on the panel. And before we go into the discussion, I would just like to briefly introduce them. Lena Kozani, founding partner of Horizon Capital. Horizon is a preeminent Ukrainian fund primarily, but also Central and Eastern Europe, have raised 7 funds, of which the EBRD has supported 4, including currently the so-called catalyse fund to mobilize foreign direct investment into asset-heavy industries. Horizon also has never closed their offices in Kiev for a single day during the war, right? I think that is something which is quite spectacular. Lena has been recognized with a number of awards, including the Order of Merit for Service to Ukraine by President Zelensky. So a very distinguished, esteemed colleague here. Christoph Kulik, founding and senior partner at Innova Capital. Innova is also a mid-market-based buyout firm, so take controlling investments, typical size 25 to 40 million per ticket, have also raised 7 funds. The 8th fund is under consideration. We as EBRD are an LP in 4 of those funds, but we also have quite a large number of co-investments with them. 1.6 billion or so of assets under management, so a very sizable fund. Diamante Kosaikate is the managing partner for private equity in Invalda. Invalda is a multi-asset company. Diamante runs private equity. The firm was already established in 1991, listed actually on the Nasdaq Vilnius since 1995. So it's a publicly listed entity. 2.1 billion of assets under management. Diamante, again, looks after the private equity deals, has a huge amount of deal expertise under her belt. EBRD is not yet an LP, or hasn't been an LP, so that's the only distinction, but otherwise we have 3 spectacular funds. And Wojtek Subiraj is the CEO of Vodeno, but also UniCredit Poland. Wojtek launched Alio Bank in 2008, which was sort of the first, if you will, digital internet-based company, very innovative, IPO'd it as the first and largest private company on the Warsaw Stock Exchange. Subsequently founded Vodeno and also Ion Bank. Both institutions were bought by UniCredit in 2024. EBRD was an investor in Vodeno as well, so we sold out very quickly. And because of the acquisition by UniCredit, Wojtek is now CEO of Vodeno, but also UniCredit Poland. And while we have 3 fund investors, we have a quintessential entrepreneur who can talk about equity from the side of an entrepreneur, and I think a serial bank builder. So this, in terms of introduction, and I think these are the parties that we as EBRD and others really work with to make our mandate literally hit the ground. With that, I would maybe just start the conversation, starting with you, Lena. If we talk about framing the role of equity in development finance, and the simple question is maybe, what problems can equity solve that debt doesn't address? Because as I just said, we are mostly a debt organization.
First of all, thank you so much, Dirk, for the introduction and also for inviting us to contribute to this panel. As you've mentioned, we focus on Ukraine and Moldova, and this year we celebrate 20 years. So it's been 20 years of operating through devaluation, through crisis, through all of the invasion, annexation, full-fledged. And it's very important that we have the partners like EBRD behind us. So obviously Ukraine is capital starved, and everyone can see that Ukraine desperately needs equity. We believe very strongly that first equity is crucial. It's crucial for the deal. It's crucial to pull the whole deal together. If we look at what has happened, I mean, everyone is very impressed with how resilient the Ukrainian economy is. And truly, when you look at it, the economy was at 200 billion nominal GDP before the full-fledged invasion, went to 160, back up to 214. And but when you break that down further, and this explains more about the equity problem, is that, FDI decreased 90%. So FDI decreased 90%. It's back to only 2/3 of what it was in 2021. And most of that is reinvested earnings. And then when you look at domestic loans to the private sector, I mean, it's only 12% of GDP. When you look at capital investment, it's down 40% in the first year and has only bounced back to 80% of 2021. So let's start off within Ukraine. It is capital starved. And when we look at the needs everyone sees them. Everybody knows about the World Bank report, 588 billion in energy, which is something that we all care about, that everyone saw the blackouts, 10 to 18 hours on average, the blackouts over the winter, 10 gigawatts of energy gone, an immediate need of 11 billion for energy investments. And what equity solves, which is what obviously we believe in very much with Catalyst Fund and others, that first equity, is equity achieves the multiplier effect. So without that first equity, you will not attract the additional equity, you will not attract the debt to project. And we've seen that across all the projects. The first project in the Catalyst Fund is a good illustration. 29 million euros in equity catalyzes 245 million capital, and that's the additional equity and debt, and allows a 124 megawatt project, a wind farm in Odessa region, to take shape and to be, to be pulled together and start the process. So equity de-risks, it allows the capital multiplier, it's long-term, and truly it expands the pool of bankable deals. So
Yes.
very important that EBRD is backing financial intermediaries like us who do provide that first equity. In our case, minority growth equity. We're not a buyout fund, and it makes it very important.
Yes, thank you. No, and maybe I can continue on this topic a little bit with you, Christoph, which is more really equity versus debt, a little bit more strategic trade-offs. If you look at projects, are you assessing them purely from an equity lens, or do you take things like concessional finance or blended finance, one of those IFI and other institutional instruments, into account?
Well, I think that what we say is that equity builds companies and debt sustains companies. So if you look at businesses which are sort of with debt, there's usually businesses with stable cash flows and stable position that you can take, you have a basically lower risk. And I think that's not what we do. We do control buyouts, but we do a lot of work with the companies that we buy. We usually are the first institutional investor in the business, and the businesses are funders-led. So they are a little bit different. They need a lot of work on, and then they need somebody who's going to take the risk. And he's going to take the risk pari passu with the funders. So our model is that we don't buy 100%, but basically we partner with entrepreneurs and take the companies to the next level. We have our own methodology. We call it the 3I, which is institutionalize, internationalize, and innovate. And if all of these three things need equity, you cannot do it with debt because there's too much risk involved in any of the steps. And if I look at 30 years of our investments history, where the things go wrong, we usually say there are no bad companies, but sometimes they run out of time. But what really accelerates running out of time is too much debt. So when our portfolio, we usually don't put more than 2.5 debt to EBITDA. So we really have a cushion in case that something takes more time than we thought. Plus, you have all this, external factors which come in. When we look at our last portfolio, the portfolio went through COVID. Portfolio went through war in Ukraine. So you need to have, when you do all this transformation, when you digitalize businesses, when you grow them through the acquisitions, when you put new management in this, you need to have a buffer that only equity can take in building these businesses. And of course, we're not against debt. And I think that especially for larger projects, infrastructure projects, you need to have a blended finance. You need to have debt. You need maybe have a more structured debt, which is still something that we don't have that much in our part of Europe. But that is needed as well. But again, for what we do, for transformations, for building companies, and I think there's a great opportunity now in Central Europe because the companies are getting to the size where they can, from good companies, become great companies and European challengers. That's what we would love to see. We would love to see companies which have headquarters in Central Europe, in Prague, in Warsaw, in Riga, which have more courage to go and expand into Western Europe and compete, because they can now. They can in terms of quality of the management. They can in terms of the innovation and digitalization and technology. Very often those companies are more innovative than the Western counterparts. I mean, Wojtek is going to talk about his projects, but his project basically takes over the whole Europe. And that's what we would like to see. But again, that requires somebody taking the risk, underwrites risk of equity.
What I found very interesting is because you have, in the market, there's the perception that private equity basically runs on maximum leverage. This is how you make returns. And you have said exactly the opposite. You will remain very cautious and reasonable in the leverage. So leverage is not your modus operandi to make returns.
Absolutely not. And I think that people, exactly, there's some stereotypes and misconception about how we work. We're not KKRs of the world, or, other guys. We do a lot of build up in the portfolio. We don't just use leverage. We don't leverage companies up to their nose, and then wait a couple of years and sell. And then also other thing is that people say that private equity is very short term, and I think there's another misconception. Our holding periods now are between 5 to 7 years, and these are of course I would say a mid-term, but definitely it's not a short term. And the amount of work that goes into that 5 to 7 years is very often more than some companies put 10 or 20 years. And so it is transformative in that sense.
Diamant, I want to move to a topic which is always, of course, a consideration for us, which is ESG, or we call it impact, a transition impact, environmental, social governance. And the question is there a trade-off, or would you trade strong financial performance or success against impact-driven objectives? Would you say, because you're also ESG focused, but do you still view it mostly from a profitability perspective, or how do you see that impact is sort of implemented into the equity strategy?
So maybe first of all, we can bring in like upfront the friction itself that's there. So the development banks like EBRD, if you look at it, they bring real, genuine additionality with respect to governance uplift, sustainability framework, stakeholder accountability, risk management. However, this may and typically is seen by the founders or pure commercial corporate investors as a friction, so that it just brings cost, additional cost, so that it's seen as a drag or constraint for execution speed, management bandwidth. And we face the same ourselves as well. And I believe that's all about simple structuring and making sure it lands at additional value and not a friction or additional cost, risk, or constraint. And I can use very simple examples because how we approach it as it's not something we do because somebody told us to do. It's because we believe in that. And we are not an impact fund. We're obviously, our main goal is to bring financial returns that our LPs expect. And we do promise high financial returns. We promise to our LPs top quartile European returns. So we have to bring it. We are not impact fund. But one does not go without the other. And through a very simple lens, obviously, as long as you keep it proportionate and calibrated to the stage where your company is. And the examples would be maybe a couple of examples, like take healthcare services. Amazing deal that we've done, if in private equity star companies where you generate above 5x, so that's one of the star companies. And it's very simple, that's societal impact. You invest, what your goal is to improve the access to healthcare and improve healthcare quality. You measure it by NPS, and you see growth. You see accelerated growth and amazing growth in the revenues. You take environmental services, waste management. You have a goal to reduce CO2 emissions. You go with a greener fleet. You can win more projects, more areas to manage. Your revenue goes up. You reduce your energy. You look for ways how to reduce your energy consumption. It saves you money. Your margin improves. So through very simple, very practical things without any rocket science.
So this is something which will prove itself out during the investment. One of our objectives is obviously to mobilize private investors who have maybe a narrower target, right? Do you feel or do you see in your experience that it is difficult or requires more discussions with purely commercial investors to sort of subscribe to this ESG concept without sort of associating that with, you know, less money, less profitability, more social impact for its own sake?
Yes, it does take, but it's like a learning curve. It simply takes more discussions. And I've recently had discussion with the founder. So we have actually the same strategy as Innova in Poland, in a sense as well, partnering with the founders. So just enter it a company with the 75%, and those 25% remain with the founders. And they were saying the same, what? ESG, what reporting? Are you going to pay for this? And it took some time during the discussions because we had to embed it in training the shareholders agreement. And it took some time within the discussions. And it's still a learning curve to prove that if and when you follow, it actually brings financial results. So it works for the benefit of everyone. So that's what I was saying. It's about structuring and helping to understand that this brings value and it lands as value, not something that drags you down.
This is why I'm saying we have the strongest partners here on the panel.
But that is a big difference when you actually, the private equity funds started to do ESG as actionable item, because before that we did a lot of reporting and we were trailblazers in reporting. Now all of us have people who are responsible for ESG in our organization, and their agenda is work with portfolio companies to actually impose that as a working plan based on bonuses. You know, people are compensated because of that. And once it becomes really an item and brings results, there's a game changer.
Yes. Well, we've done one more thing since, to be honest, I do not recall, but a few years ago, in the largest companies, you cannot do it on a smaller asset, but in our largest assets, we've linked management bonuses to the ESG KPIs. And
okay, that's convincing. The title of our panel is about innovation also. And I think this is where I would like to move it over to you, Wojtek. Innovation economy opportunities, specifically, of course, the digital economy, which is where you made your experience in all of this. And the question is this a sector that offers the biggest potential for equity to sort of catalyze development, that particular digital sector?
So, first of all, thank you very much for bringing me here. It's partner of EBRD for many years, more than 20, in different ventures. I believe that there are two observations that I would like to share in this subject. One is, you mentioned earlier that the equity is more about the teams. I believe that it is very, very true. If you go to the bankers' offices, they have the tombstones, and they say, okay, this is the company when we arrange that much of a debt, that much of a securitization. It's striking for me that you don't see that from the company's perspective. From the company's perspective, you see who are my shareholders. From the purely financial statement is we trust you with our money, but it's a different type of trust. And believe me, it's very difficult to go and say, okay, this is where I raised my debt. Okay, fine. But this is the companies the partners that I build the company with. And this is very much different. And that leads me to the question of innovation. Because that is about assets, that's about the cash flows. Equity is about the ideas and building the market shares. In the time of unprecedented growth on the technological side that we are facing right now, well, we can go and say, okay, there are a lot of data centers to be built. There are a lot of cash flows that are provided and secured. So let's finance this by debt. And there's nothing wrong with this. But a lot or majority or vast majority of the value on the innovation and technological revolution that we are facing, especially in the era of AI, will be built on ideas And these ideas are not bankable and not sustainable by debt, by definition. So this is the finding moment of us as a bankers, institutions, investors, founders, to find a way to cooperate, to get us through this wave of the innovation built and innovation-based companies. If we don't fix these issues, both on the seed financing and the second round of financing, we will, as a Europe, as the region, we will see the huge decline in our companies and in our investors escaping financial markets in Europe and going elsewhere. And there are discussions currently about the capital market unions. I believe that our reason to be is to feed the capital markets with the new companies, with the new prospects to build on this revolution, on the innovation. It's not that moment is the equity moment.
No, I think it's very important to recognize innovation by definition always needs risk capital. It needs equity. Obviously, Silicon Valley benefits from billions of funds, so we're not in that space, but it is all risk-taking capital. And with debt, you're completely right, debt is secured, even if it is earlier stage debt. Equity, I think this is a big recognition for us also as a development institution, because innovation, building the ecosystems is important to us, and I think equity is the product to do it.
Yeah, absolutely. And also, I think that we had a lot of discussions in this conference and around about the building the sustainable growth and financial future for the societies. And look, in our part of the world, this participation in capital markets is very small. It needs to be built. It needs to be kind of generated, and people should be given the access to the new investments, new technologies, new innovations. And just 1 second, I have it somewhere. Bear with me. It's Revolut was given the access to the IPO of SpaceX.
Revolut.
SpaceX listing. Revolut. Page cannot be viewed. Related to SpaceX can only be viewed by persons located in the UK or Germany, Denmark, France, Netherlands, Norway, Spain, or Sweden. Thank you very much.
Yes.
So it means what? I'm not here the salesman of SpaceX, just don't get me wrong. Yeah? But I think it's all about the choice, and the choice is where we our societies, our investors have the choice, and this choice is not there. So I think the time when it was the big banks having the commission to distribute this to the people for their retail part, it's gone. Now the people with the AI has the access, and they demand the access, and we are here to help them with it.
So I take it fintech is a big portion of innovation through our countries.
Huge. It changes everything. Like small things. Last week, I think it was Robinhood that emerged embed the AI-driven advisory into their portfolio. What it means in practice, it means that Mr. Kowalski sits, watch the Roland Garros or something, and then ask the question, this is my investment profile, what should I buy? It changes the thing. It's not the broker that gives the call and advice. It's the AI and the fintechs that are empowering thousands of people to make these investment decisions. And I think we we should, in my opinion, support both the fintechs that offer these products, but also to make sure that by certifying, by investing, we are trying to make the life of retail investors a little bit easier.
Yeah. Lena, if I come back to more a structural question, which is how do we mobilize private domestic capital? Obviously, we're always concerned about bringing foreign direct investments into our market, but foreign direct investment also looks at what do the domestic providers do. And are there, does the partnership with us, for example, help in this, or what are your thoughts about mobilizing domestic capital?
Yeah, that's a very good question. In terms of Ukraine, of course, the domestic capital, there's estimated about 400 billion that we like to say is under mattresses. Typically, it is on deposit accounts, et cetera. That capital is enjoying earning interest in deposit accounts. It's very difficult. There's very few avenues right now to mobilize that domestic capital. Where we see it going is into startups, as angel investors into tech companies. We've seen that domestic capital go into defense sector, for example, when no one was putting money into defense. Now it's almost 60 billion industry. But for us, we have not tapped into domestic capital historically. Different reasons, but typically it may be family offices of industrialists. There may be PEP concerns or KYC concerns or confidentiality concerns because obviously as private equity, you want to keep your multiples and your company information private. And that has been a challenge in the market. So, mobilization of, I wouldn't only focus on domestic. I think for Ukraine, given there's so many needs and the capital base within the country is still not enough to cover what the country needs, there really is such a focus on bringing in private capital. I mean, that is essential to bring in the capital from outside the country. And that's obviously, taking it back to development institutions, that is such a key role. I mean, we saw the panel with Odile, the Sub-Saharan Africa panel. And one of the questions on the screen that I really loved was when it said, how do you measure successful partnership with development banks? And 52% said mobilization of private capital. And I think that's certainly what we see across our market is that role is very important. The development banks are looking for impact and returns, and that's absolutely what it should be. And their role of anchoring funds, of providing acquisition finance for buyers entering the market, for co-investing, co-financing, providing debt. Let's not say that debt is a bad word. It isn't. It needs to be anchored with equity. Equity is crucial and key, but you do need debt, and you do need acquisition finance, and you do need folks who are going to come in and be in the cap table alongside cornerstones for IPOs, et cetera. So there's a wide range. Domestic capital important, but also that mobilization of global capital. And with Ukraine, with a 588 billion need, you look at every sector, energy, 90 billion, 2/3 is estimated to come from the private sector. And that private sector will include international strategics, global funds. So a lot of what we do is focused outside of Ukraine to bring those kind of opportunities and raise the level of interest among those who may want to enter now, and we've seen that. We saw that together, Dirk, with the telecom deal.
Yes.
I mean, who would have thought that we could have mobilized an investor like Xavier Niel, who's...
And maybe you have a minute on it.
I would love to, because I think it's such a great example and an example of what I think we're all trying to do in our markets. Xavier, of course, is a telecom guru, a tech guru. He's in 20 countries, 100 million subscribers. We went to him to buy the platform that we were developing. We had the #1 fiber optic cable company in Ukraine. We used acquisition finance from EBRD to buy the #1 pay TV platform from Providence. We brought them together, then went to Xavier. We pre-approved with Turkcell the purchase of LifeCell, their number 3 mobile operator. And we went to Xavier, said, we would like you to buy this platform. We think this is a great way to enter the market. You're not in Ukraine, but we see on the map in your office that Ukraine is one of the countries that you want to be in. This is a perfect opportunity. And they said 2 things. One, we want a debt partner. We want a partner like EBRD alongside us, who has been, largest investor in the market and very important for us. And also, we want you to be a 10% minority investor. So, I think what we together achieved with EBRD, with IFC, the 435 million package. I mean, imagine, folks, to bring in a 1.5 billion investment during the full-fledged invasion of Xavier coming into the market, acquiring this platform, us investing alongside, but to have the 435 that EBRD and IFC anchored with the European Commission funding, it was really a landmark deal. And I think that's a lesson for all of us who are working in these markets, is that we're not putting barriers in front of us. We're not saying this can't be done. War will not stop us. Lack of capital markets or this kind of issue or that issue will not stop us. We get things done because we've got the partners beside us and because we've got the motivation and the incentive and the desire to make things happen.
Yeah, that's why equity is a conviction game, and it's the guitar solo, not the orchestra.
It's a conviction game, and you're playing a big role in that game, providing equity to these funds. Because without because everyone on the stage, we're deal makers. We're deal makers. And if not us to pull the deal together, it wouldn't happen.
Can I ask you, Christoph, is there a role that policy or ecosystem enablers or the government can actually play to either create a more level playing field or to sort of incentivize innovation? Are there policy reforms due or imaginable that can increase equity investments into our markets?
Yes, the answer is yes. But let me start with the thing that I believe is one of the most important things, especially for equity and for investments, is predictability. I think that is something that when we go and we talk to investors from different parts of the world, that is something that always comes up. Are these markets predictable? Is there law changes all the time? You get into the game and then the rules of the game change on you. And this is something that should be absolutely number one for governing bodies, is to make sure that your markets, because stability, predictability is something that equity needs. Because we have enough of our own challenges to deal with. And that, if that comes on the top of it, it can turn things up and down. The second thing to availability of equity. 30 years ago, when we were living in the sort of much poorer countries than we are today, especially Poland, there was no equity, right? And there was no savings. The country was relatively poor. When you look today, Poland is $1 trillion economy. The assets of households' assets now are above 1 trillion euro. So there is money. The question is how are you going to activate to incentivize people and organizations to invest this money in the more risky and equity. And Poland has gone through lots of bad decisions in pension plans and pension programs. There's still 200 billion euros in pensions in Poland. But pensions do not invest in private markets. They cannot invest in private equity because they're required to do daily valuation. There's liquidity limits. And all of this, which doesn't allow them to invest. And when you look at successful markets, let's say Canada, right? Canada doesn't have that, at that time, didn't have that much more savings than Poland did, but they had professional teams who were in the pension funds, and for years they built capacity and knowledge to invest in private equity. We have to build this. I mean, without this, it's going to be very difficult for us to grow. Funds like us, they should have 50% of their funding from local pension funds. When you look all over the world, from Chile to Canada and US, there is pension funds in the end of the game, and without that, it's going to be very difficult. So those changes, are very important for a sort of a long-term development of private equity and private markets in our part of the world. And there is in Poland, they're trying to activate some of this. We have this program which is called Innovate Poland, which is the largest Polish insurance company, development bank, and they teamed up together to try to. They raised 500 million euros, which is also already something, but it's nothing. When you look at private equity investments in Poland, we are 0.2% of GDP.
Yeah.
We're still boutique business, if you think about it, and the impact on economy. So that has to come in. There has to be more. If you think about 1 trillion investments, if you just take 2% of this, 2% allocation to private equity, this will be a game changer for all of us in the region.
Absolutely.
It will be a lot of money that can fuel this.
Yeah.
And I think again, as Lena said, without us, it's very difficult to think that money is going to be put into work in a profitable way.
Yeah.
And especially also referring to what Wojtek said, the technology investment innovation is not just, funny thing to have. I mean, it's a very important systematic question, because if we talk about sovereignty of data, we're talking about cybersecurity. I mean, this is all around IT. And technology, and if we don't have our investments, if we don't take it over, then basically we're going to outsource it to US, and we wake up one day and then everything is going to be made in the US, transformed in the US, and we're all going to be driving in the Chinese cars.
Yes.
And that's the end of the game, right?
Yes. Okay, thank you.
Doomsday.
I would like to just have one little excursion to you, Wojtek, and maybe just some lessons or your experience from the Vodeno build-out, Ion build-out. You needed capital, obviously, to build it out. You sold it ultimately, but if you had a minute on sort of the journey to this success, because that is, again, very entrepreneurial, equity-heavy, and I think very instructive for us to understand.
I think obviously I can go with the entrepreneurial spirit, and I think the very, very important at the very beginning is to realize that any failure is just a stepstone for the success, and experiment, be brave, take the risks, invest, and learn from the Baltics, because I think this is the problem in Poland, is that we are kind of too big to ignore. But I think we always envy the Baltics, looking at the world is my oyster kind of approach, rather than focusing on regions in the country. So I think sometimes it's difficult, especially when it's closer to the IPOs. But I think having the open discussions and be with the investors is crucial. Let me give the example. When we built the infrastructure to have the FX flows without the commission the same time that Revolut built this. It recognized to put some service in London to be connected to the markets. Okay, same time, we've been on the same place. And then I went to investors and asked them, look, are you able to sacrifice the 3/4 of our profits, of our reports, if we do the FX commission-free trading for all the companies in Poland, and we capture this market, and then we go throughout the region and all the other markets? And at that time, the answer was no. We've been already listed. No, you cannot sacrifice. I think I believe that the word would be different if I had the discussion earlier, before the listing, having in the room the investors that would understand the ideas. That's why having the open dialogue, and I'm so happy to have this dialogue throughout all the ventures, with the EBRD, looking at the opportunities, not inside the countries, but outside, and looking at the technology as an enabler. And maybe this is the one thing linked to the question that you asked earlier. I believe that we need to see where the ball is going to be, not kind of share the the stories from the past. Over the next years, the distributed ledger and stable coins will become part of our game, like it or not. It's not just idea, which means that the Americans will have the stable dollar, the euro will have catalyse and the stable euro, and all our countries. We are not US, we are not in Eurozone, no, some of us are not. We need to go through this journey. And I think there will be plenty of companies that would help us to move into the stable coins and also to increase the parameter of what is currently called the equity. Because with the tokenization of assets, we can go into real estate, we can go into any form of deeds, any form of general ledgers, any form of trade finance instruments, letter of credits. The opportunities are endless there. So I would say this is something to have open discussions with the investors about the opportunities that are opened by new technologies. This would be the common theme.
Okay. No, thank you. I would like to go back to one topic which we've sort of touched upon briefly, which is market liquidity and fundraising. I mean, the three of you are very successful fundraisers, but it's not necessarily the norm. We see a lot of funds who don't manage. The environment is, of course, very difficult. If you don't exit, you discourage new investors from coming in as well, because people to top up want to see money returned first. And maybe I start with you, Diamante. Any thoughts on are secondaries, for example, an incremental instrument to it? So secondaries in the sense a fund can buy out LPs from other funds to provide liquidity, signal to the market there is exit opportunity, or even buy out early stage investors in an earlier stage company that have been in there for a long time, that want to recycle capital, but the company isn't ready for IPO or a strategic deal. So are there ways to increase liquidity and velocity of money turnover in the markets?
Yeah, that's what I call the wheel of life. You don't exit, you don't get capital back, you do not reinvest into the funds. But however we look at it, it was something new, some 10 years ago. However, that now it's becoming more and more important, the secondaries. And we've seen this globally. Managers struggling with exits, and the secondaries market is just booming. It's just increasing year by year significantly. And this is as well, I believe, for the development banks, there's a role to play for our market, because to think of how many continuation vehicles, let's say, we've had, or secondaries we've had in the CE market, there's not many that you can think of. And when you think yourself about potential secondary or continuation vehicle, you start struggling, because all those secondary providers, they're like, yes, it's interesting, let's hear that, but we haven't done anything in CE. It's not exactly the geography we would like to enter. And you need conviction. You need conviction of that. And for the GPs to secure the secondary, to secure the liquidity when it's really, really required to continue going, and especially in the cases where you really have a lot of additional work to do with the asset, so it can grow significantly and provide significantly larger returns. Some secondary kind of fund that would allow to, again, bring in private capital, being anchored by the development bank, I would think that for the market, that would be really very, very helpful.
Christoph?
I agree. I mean, having more options is always good. So when I look at the past, 80% of our exits were to strategic investors. And the way when we assess the investment, we always look sort of towards the end game. Who is going to be a potential buyer for this? Are we really creating something which is must buy for that buyer? So, of course, I don't think nothing's going to replace that. It is going to still be our main exit route. Now, the secondary addresses one very interesting issue, which is, by nature, the definition of private equity is a long-term instrument that is illiquid. So, we have 10 years funds for a reason. We need time to build those companies, as we talked talked before. But there's a certain group of investors that I think might be very, very interested in this. Because some investors would say, I don't care about liquidity as long as you can have deal which you keep 10 years, and then if you make 5x on the deal, I'm still happy. But there are investors who need the liquidity because if they want to recommit, they need the money to come back. And also what I think is, it would be quite interesting to mobilize private capital. So I'm talking about private investors, family offices who come into private equity very often for the first time. I have such investors in our fund. And they invest in one fund, and then of course they have to wait a couple of years for the money to come back. If there was secondary player, a strong secondary play, which would offer a viable alternative, a viable way for them to sell the stakes 3 years, 4 years, 5 years into the life of the fund, with the return, based on the net asset value of the fund, people could make 2x, 1.8x in 3-4 years, which would be good enough, still beat the other asset classes, but would give them more option to liquidity. And I think to what you said, Milena said, there's a lot of co-investment vehicles, right? I mean, you just read about how this works and how maybe not necessarily good it is. I think in our part of the world, it's a challenge. That there's no such a player as we are in primary. There should be more secondary players. But also what I find interesting is that for us also secondary is ability to exit to other private equity funds. And where we are, we build these mid-sized companies into much larger. And then if we manage to build in much larger companies and they still have another chapter in front of them, that could also be interesting. We just did a sports isotonic drinks company in Poland called Oshi. And they have 80% of market share. They got rid of Gatorade and Powerade. It basically doesn't exist in Polish markets. Absolute success story. And then we sold our stake to other private equity fund who their premise is to take this company and roll out this internationally throughout whole
Yes.
I think that's very interesting.
Anything else on that, or secondaries, liquidity creation, exit issues? I mean, you're maybe not the best person to ask because you've cracked it, but
No, there's a lot of lessons that we've learned along the way, and I would say the hardest fund to raise is the first fund. The hardest fund to raise is the first, and in our case, we came from the enterprise funds, right? So for example, Polish American Enterprise Fund morphed into enterprise investors. In our case, we cut our teeth managing U.S. government money and then spun out 20 years ago into Horizon Capital. And we did everything to de-risk that first fund. We warehouse deals, we secured an anchor commitment, and instead of taking the capital, we used it to warehouse deals that were then transferred into the fund. We did everything we could in order to be oversubscribed for that first fund, and then it got the ball rolling. But I think for us, obviously, we are in a difficult geography. Ukraine and Moldova, these are not easy geographies. And over the years, it's very important. The track record, the liquidity. We don't compare ourselves to other funds in Ukraine. We compare ourselves, Cambridge Associates, emerging market peers, top 5% of all of our funds in benchmarking, and you have to perform, you have to have the track record, the liquidity. We see some of the funds in our market where they're great at investing and then they can't sell anything, because they're holding on, it's going to go higher. No, when the window opens, you run through it, and that's something that we have always done. I think, to return over $1 billion to our LPs in the last decade, and then the biggest year was in the last 2 years, $400 million in the last 2 years during full-fledged invasion. So it's not easy. Fundraising is not easy in our environment, but don't let anyone tell you can't do it. Never stop. I mean, it is a numbers game too. I mean, Christoph, I know you're on the trail right now, and you've been gone for 2 months.
Right.
I mean, it is nonstop. You'll talk to 100 investors, 70 knows, 30 will come forward. I mean, this is something where
by one of the LPs, I think I told you that.
Yeah.
They said, so he asked me, how many managers are there in the world? He said, no, enlighten me. He said 8,000. And I said, what about top quartile? Because we are top quartile. What about top quartile? He looks at me and said, 2,000.
in one definition of quartile, it's right.
Right.
Yeah, that's right, exactly.
But I thought what you said was very interesting, because to exit, you need to have the discipline to maybe take money off the table despite the theoretical opportunity for in another years or 2 years' time to maximize. But then you need to know what to aim for. I wanted to ask one. Sorry.
You need to know what to aim for, but you also need the agility. Because you were talking about secondaries, I just wanted to touch on that because, we, within our group, when we saw one of our LPs in our vintage 2008 fund came to us, San Diego County, and said, you know what, we would like, if you thought about a GP-led secondary, it's easier for us to exit as part of that than to try to sell our one, small stake. And that got us on 100 days to do a GP-led, the first in our region. And, it really, I'm a real big believer because, there's a lot of myths that you can bust. I mean, folks are saying, well, Ukraine, you'll get a 40% discount. We ended up with a 5% premium for the LPs who were exiting. So, be brave. Everything's possible. If we can do it in Ukraine, you can do it in Poland and Central Europe, everywhere else.
I think be brave. So I have one last question because I want to also open it up to Q&A if possible. And I might regret the question, but I am brave now. And I'm saying there must be also some instructive examples of success or failure when working with development banks. And I think you have different journeys. Maybe, Wojtek, you worked with us. And if there were things we should improve, by all means, this is the audience to sort of tell it to.
I think openness for the ideas that are not repetitive in nature. So EBRD and most of the investors are quite good in show me the benchmarks, show me the examples, pushing us into fast copying of the ideas from Southeast Asia or from Latin America, unfortunately less from Western Europe. And I think this mentality must change because with the fast changing AI-driven, there will be not that many of to be copied.
Yes.
There will be a lot of to be created and innovative.
Yeah.
So if we don't get from the section of worldwide benchmarks into talking to the people, getting their ideas, I think this is what we experienced.
Yes.
And it was okay because building the digital bank from Poland was kind of a stupid idea in the 2008, but we made it. Yeah. But I think now there will be many, many more of these opportunities.
Diamante?
It's something what but could be improved. I think for everybody, it's the calibration and the proportionality of impact and the focus of any institutional investor, of any of us here sitting for really high financial returns. So we need to calibrate it.
Okay.
Well, I think that the success of development institutions in the BRD should be always measured in the amount of euros or dollars it mobilizes. And I think that there could not be a successful fundraising for any of the equity funds in our part of the world without the BRD and other DFIs. I think that's a must. People are looking into, in our industry, what we call the first close, and they're looking into re-upping of your existing investors, and they're looking for a very strong first close, and then you can attract other investors. And when I look at our funds, EBRD has been historically 10 to 15%. The other DFIs maybe another 10%, but 70% was private money. And without this mobilization, without first close, which is usually possible because of you, that we would never be able to do that. As you said, I've been on the road for the last 2 months. I met 70 different institutions from Western Europe and US, and they're all going to be looking into what's going to happen to first close. They're intrigued by the region, but they want somebody to underwrite the first risk.
Okay.
And that's
Oh,
where you
yeah,
come
yeah.
in.
Yeah.
And I would encourage you to do it, continuously do it, and
All right.
be bolder, be
Listen,
bolder.
yes.
And I think that also the other thing that, if I may suggest something, is to basically help also the best managers, the best quality managers, to expand not only the size of the funds, because that we should be disciplined, because you always should have a fund size which is relevant to the opportunity, but also help us expand into the other, other asset classes, you know, and help building it. I think that is something that I would say is the next step.
If I may, with one sentence to add up to what Krzysztof said, like the importance of the DFIs for our region. So irrespective of the fact that we've been on the ground for over 30 years, our first private equity fund as a fund was launched in 2019. Today, so last year we've finished fundraising in 8 months. We've been targeting 250. We closed above hard cap. We raised 410. So these are, and the first fund was 165 million, the first largest fund in the Baltics. And today we are one in between the largest in the CE. If not for the DFI, there would have never been a fund.
Dirk, I think keep doing everything that you're doing, because very agile, very quick, very responsive. And since Invalda's here, Horizon and EBRD, I do have to say that a success is Maib. You know, we talked a lot about Ukraine, but Moldova, I've never been on a panel with all three of us on a panel. And you know, to think that this is the kind of out-of-box, back of the napkin, you know, drawing out, can you imagine, $1 billion taken out of the Moldovan banking sector, and then sitting down with EBRD on the back of a napkin and saying, you know what, let's go in and buy the #1 bank in Moldova. EBRD suggested Invalda to join, and you can imagine, you know, a joint investment, this is the power of first equity, a joint investment of 27 million essentially saved the Moldovan banking sector, allowed IMF to lend, EU to provide funds, and this is a bank that's like, increased net income 5 times, you know, 2.5 times. I mean, it's a fantastic story. So
and you will make some
lots
colleagues
of
of ours
successes.
very proud who are in the audience and who are actually involved in it. Can I just, I think if there is a question or if there are a couple of Q&As, please, I think we have a little bit of time. Please, this gentleman here in the second row, I think we have, microphones.
Thank you very much. Rostislav Futalo, Ukr Bank, Ukraine. I'm chair of the board. Question to equity providers from a debt provider. What are your lessons learned? Why, and the challenges you've seen to your portfolio companies where the debt providers, the banks, not DFIs, but other banks, commercial and state-owned, what is the extra step we have to make in order to finance successfully your investee companies in our countries?
Perfect. Can we maybe take another couple of questions, yes, before we, there's another gentleman in the row behind.
Hi, thank you. My name is Richard, and I'm on the fintech technology provider side, where I've grown several companies and raised financing before. My current venture exists in 3 or 4 countries, in Bulgaria, Georgia, Armenia, Riyadh, and now we're expanding into Africa. In none of the companies that I raised financing in from investors, none of them came from banks. And as I learned more and more about the banking business and what EBRD does, so much of the focus is about doing a project, financing a project where there's a physical asset on it, where they can have leverage on it, and that's kind of the security based on which they are investing. Whereas in the Elon Musk's trillion planet, SpaceX, or any of these big potential upside investments, people have to take significant risk. Without it, you cannot have the 100-to-1 return. What can our investors here say to the banks here if they can pass that barrier, if they really want to benefit from enormous gains? What can they do to change their genetics? I guess that's my question.
Thank you. Maybe I leave that question for you, Wojtek, but for the debt providers, what can debt providers do to sort of, how can they contribute to growing the companies?
So I think, first of all, there is abundance of debt, banking debt in our part of the world. I mean, if you look at Polish market, we have a couple of banks which are very competitive, and they offer traditional financing and acquisition finance and financing for the portfolio company. So that's not an issue. Even they offer us very often higher indebtedness that we want to take. But I think what banks have to do, and especially if you want to defend your market share and not let the big private debt players to enter the market, you have to become more innovative in terms of how you structure that. So you have to think more like a unitranche product, where you have one-stop shop for private equity, and you basically modify the debt, you make it more flexible to where we are. So in terms of when there's a repayment, more towards the exit, and understand the business plan and how you do it. You have to be more elastic, more forgiving in terms of covenants very often, and that's where the bank can actually provide the unitranche for the whole life of the company. And I think that's what I would say. It's where it should go for us.
Wojtek, on fintech, that question mirrors a little bit your experience, of course. How to fund it, scale it. Banks look for security, which at that stage is not available.
I think that there are two parts. I believe that it's we need to acknowledge from the very beginning that there are stages. At the very beginning, there is only the idea, and the banks, commercial banks, should stay away from this financing the ideas, because they are institutions of public trust. And here, looking for alternative investment cycle is the only way forward. However, later, I think that we are making grave mistake as an industry, because we believed in order to avoid the mis-selling, we invented the MiFID. And MiFID is something that categorize the clients based on their knowledge. At the same time, all our clients currently are AI-driven knowledge. They know everything that we know. So I think that this is the moment of revelation, because if we don't do that, if we don't change its regulations, the AI-driven will tell the clients where to invest, and they will be looking at the source, at the institution, as the channel for their investment. And this is the moment to make sure that the industry, the banking industry as a whole, is able to provide the answer. And currently, very honestly, we're not there.
Thank you. So given that we're out of time, I will spare myself and you the closing comments. I would just like to thank you all for here being on the panel. Very interesting. I also see that there's no attrition in the audience, so that's also very good. So thank you very much for your contribution.